Hi, everyone. This is Jacqui Cooper with JCooperTravels. And today we're going to be talking about finance. We're going to be talking, topic that everyone at the beginning of a new year always thinks about. How do you plan? What should you be thinking about? How do you become, financially wiser and more responsible in different ways? Before I introduce our guest, for those that are new to my podcast, I just want to introduce myself and welcome you. My name is, again, Jacqui Cooper, and I actually am an attorney. But I transitioned from law about 18 years ago to the special education teaching side. And so I'm nationally board certified teacher, and I'm also an entrepreneur, and I'm involved in the travel space, hence the name JCooperTravels. But as I developed the podcast, I realized that I was meeting so many interesting people on LinkedIn that everyone's story needed to be shared because we are all so interconnected. And so the podcast focused both on where we travel, hence the picture behind, which is of Hawaii, as well as our personal journeys and our explorations. I know for me personally, I've been jumping into a lot of new areas this past year, and I'm taking all of you on that journey as well. So you can learn from both my successes as well as failures. But today I have Christopher here, Christopher Lakian, and he's with RH Financial Planning. And Christopher, thank you so much for being here. I really appreciate, we've had a lot of conversations, and I'm learning so much from you off recording that I wanted to bring you on so my listeners could gain and enjoy as well. How are you doing today?
Very good. Thank you very much for having me on, Jacqui. I really appreciate the opportunity.
Not a problem. So for those that are listening, I'm going to ask you to fully say the name of your business, where you're located, because you're able to actually support individuals all across the United States. So how would they find you if they were reaching out to you?
Great question. So first of all, my full name is Christopher Lakian. I'm a financial consultant, registered principal, and investment fiduciary at RH Financial Services, Raymond James. We're located in Charleston, South Carolina, Chuck Dawley Boulevard. People can locate me through our website, which is rhfin.com. That's rhfin.com. Or they can email me at christopher.lakian@raymondjames.com.
And all that information will be in the block below the podcast as well as the YouTube. So that way you can reach out if for some reason you're driving and you're not able to remember all that information. All you have to do is go to my podcast, JCooperTravels, and you can email me directly at jcoopertravels@gmail.com, and I'm happy to put you back in contact with Christopher. So today, I know I've been chatting with you, and you were talking about all the various licenses that you have. Can you kind of go through? I think you said you have 7 or 8, which is really impressive. Tell me a little bit more about each one of those.
Thank you. Yeah, so it's basically started off when I first entered the industry. I had a Series 6, which is general investments and securities, and a Series 63, which is a state registration. And then afterwards, I get a Series 7, a 65, a life and long-term care, which includes annuities, and a Series 9 and 10, which are principals licenses, and then the AIF, which stands for investment fiduciary.
So how did you get into all of this? What sparked your interest in finances and all securities, everything like that?
That's a great question. So back in the late 90s, I used to intern for my godfather's firm, Andy Maness Crespi. It's called Maness Crespi and Hart, located in New York City. And I was enthralled with the trading in the 90s, very similar to what we're seeing today. And I talked to my parents and I said, hey, I'm young, teenager. Can I have a little money, trade online? They said, absolutely. As long as you make it a joint account, I don't care what you do. And so that began the interest. And then I went to Villanova, and I was notorious for reading the Wall Street Journal in class, apparently. Every time I was bored, I'd pick up the journal and someone would be like, hey, focus. And so it just kind of blossomed into something really special. And And looking back, it was a great decision.
I remember the Wall Street Journal. For those that, are only getting your news on the internet, the Wall Street Journal, had, again, massive pages, columns, just stories, financials, everything. So what was the next step after you graduated? What kind of degree did you have?
I have a degree in liberal arts. I was doing other degrees at the time, but to be frank, I really just wanted to graduate and move forward at a specific point in college. So, I graduated in mid 2003. And if you remember, that wasn't an easy time. We were just coming out of a very severe recession. And I actually went to my father's office, which he had an office in Midtown Manhattan. And I actually started up cold calling different broker dealers in Manhattan to try to get a position. And it was a very interesting interview, actually. It was at Laidlaw where I first started working back in early 2004. And it was an experience.
So what was the internet like back then?
The internet, it was slow. It was slow. It was a little different. I mean, Netflix, I remember when they were still doing CDs and you accidentally, would send back one of your personal CDs or DVDs. They would never send it to you again. I don't know if you remember that. They'd have to claim it as their own property. I do remember 2004 being very choppy, and it was just different.
So when you were developing or starting off in this career path back then, were you working a lot online, or how were you getting your clients? Again, the reason why I ask about the internet is that we've all become so used to connecting like we are now through Zoom or through a podcast. But how did you network with people at that time period?
That's a great question. So it was a little different. I did a lot of institutional trading back then, what we call delivery versus payment, or DVP for short, also prime brokerage work. So I commonly worked with high net worth individuals and or institutions to trade through UBS and Wachovia at the time where I used to work, two separate firms. But it was different. It was just a different environment than where I am now.
So you talk about trading. What does that mean exactly for someone who might not be familiar with what you were doing?
So just for explanation to your viewers, prime brokerage trading means if you're a hedge fund, pretend, and you have accounts all over the street, and I mean all over Wall Street. So typically they'll consolidate all their assets at one financial firm. Typically now in 2020, 21, you would look into someone like JP Morgan, which has a great prime brokerage space. And then you would establish what's called DVP accounts, which means delivery versus payment. So if I was a broker, just pretend, if I was a broker working at, let's say, RBC, Royal Bank of Canada, and the portfolio manager which would have money at JP Morgan, would call the broker at RBC and say, hey, buy 100 million shares of X, and we'll send you the money. So RBC sends them the stock, JP Morgan sends them the cash, and it zeroes out.
So that reminds me a little bit about what happens on Forex trading platforms right now, but from the internet side. So is it similar to that?
It's very similar.
Okay. All right. So how did you end up having your own firm? I mean, what's the niche of your firm, and how did you go from New York to where you are right now?
That's a great story. So it's going to take me back here. So back in 2008-9, I moved down to Charleston, South Carolina, where I live now. And I had a very brief stint at Merrill Lynch. And I used to walk from my place to Merrill Lynch. And my partner now, Henry Ravenel, who's my partner, had an office on the corner. And I used to say hi to him every single morning on my way to work. And one day when I was becoming a little disenfranchised with the big broker dealer model, I stopped by and said, hey, let's talk. And one thing led to another. And now we're partners, and we share the office and do things together.
So share a little bit more about how your office works. What do you do? Who are your clients? If someone was interested in using your services, a little bit more about what do you do?
That's a good question. So primarily our clients are individual businesses who require a local hands-on financial consultant or portfolio manager to help them manage their assets more efficiently. One of the things that we do very well is manage money to reach people's financial goals using several different systems that all link together. It's transparent, it's clear, it's concise. You understand what decisions are being made. And the two of us have different methods. So sometimes if one's not working, the other one takes over. It works really, really well.
So how large are your clients? Are they, if would it be, and what age range? I mean, is it like a family that could come in and say, okay, this is what we want to do, or is it someone just getting started? Who are you helping?
So typically, we'll help anybody. I mean, we want to help everybody, get off the ground. I remember when I was young and I was looking for financial advice, people that didn't want to help me, I kind of turned away from. So anybody that comes in here and just wants to chat, I would love to talk to them. I love being a student of the market. I love sharing knowledge. Typically, though, our clients that we work with, can be entire families. Right now, as an office, we have over $80 million in assets, and our accounts range from all the way from $250,000 up to, the millions of dollars. And very commonly, we have the children's accounts as well, or the grandchildren to work with. So, a lot of things that Henry and I share together that we're very proud of is being able to reach different generations. He's older, he's in his 70s. I'm 42. And so we can reach a broad range of clientele to help, identify with. People that are older like to know that I have an older partner. People that are younger like to know that my older partner has someone younger.
Exactly.
And so it works great.
Exactly. It provides a great balance. Now, one of the topics, I mean, we've talked about a lot of things off record, which we'll end up doing continuing podcasts on. But one of the topics that we talked about that was very important to be taken into account, especially because financial markets go up and down, is debt. So what sort of insight do you want to share about your knowledge about where the markets are now, and, just with that topic of debt, what would you like to share with the listeners?
Sure. Well, there's two separate subjects here. So there's the debt that we've accumulated as a nation and as in the world, and then there's where the markets are, the equity markets are. And so, and in a moment we have debt adding to the euphoria of the equity market here in the United States. I mean, this has been a very robust, very short recovery for a recession. In fact, not to play some history here, I mean, this is the third recession I've managed money now through, personally and professionally. And it's never been this fast. Never. And that's because of all the money we have spent has gone somewhere like a sugar high, in my opinion. And eventually you have to pay it back because it wasn't infrastructure related. So the debt that we've accumulated, and I'll stop, is not related to an investment return. It was simply there to replace what people had lost.
So, and I'm just going to kind of think through in my head and kind of restate what I was hearing. The fact that we've gone through and this recession so fast is because of the dollars that were created possibly, and then the dollars got spent in the economy, which helped create that cycle of return. Is that a correct way to restate it?
Yes. So there's two factors in the way the speed of the recovery. First of all, it was an event that caused the recession to begin with. It wasn't a structural deficiency like 2008. It was a structural deficiency that needed to be worked through the system. What happened in March and the way we recovered, first of all, was due to the speed and execution of the Federal Reserve firming up the market in late March, early April through quantitative easing. This is not a concept that was considered here in the United States back in the late 90s, early 2000s. It was really only considered by Ben Bernanke in 2009 when he did QE1 and TARP, Toxic Asset Relief Program, of $1 trillion to help starve off the financial crisis.
So the previous recessions were caused then by structure?
Mm-hmm. That's correct.
And I'll be really honest, I I remember generically, but I don't remember the specifics of what it was that triggered those various recessions. Are you able to speak to that?
Absolutely. So the last major recession that we had, the Depression of 2008, was almost, you could argue, was a depression in some retrospects, was caused by excess leverage in the financial system, which was started back in 1999 through removal of, I believe it was Dodd-Frank. And, when you had to dismantle the financial firm leverage, someone explained to me like this. They basically took 24 Coke cans and put them on a table. And then they put one Pepsi can at the end. So it's like a whole domino, okay? And they said, the company is only worth this one Pepsi can. But to get to it, you have to sell all these Coke cans to get to the bottom. And that was dangerous leverage in the system that was stacked on over years and years and years, compounding the problem. And it had to be worked out of the system.
So, where do you see the market going now? And again, I know there's no magic ball and anything can happen, but with the debt that you were talking about, the fact that even though we recovered from it, and like you said, we have to pay it back, what do you think might be happening in the future? Because again, how do we pay it back?
That's a great question. We pay it back over a long period of time. Hopefully what the Treasury purchased and issued doesn't mature next year. Hopefully it matures in 30 years, 20 to 30 years. But in the near term, it does become a problem because, we were financing debt almost at negative yielding rates. In fact, I remember not too long ago, I had to buy a 1-year Treasury for a client, and it virtually yielded nothing. It was nothing. And so as inflation takes hold in the economy and the real economy recovers, which we all hope it will, inflation and productivity pick up. And when you get inflation going up, you get bond yields going up. So all that money that has to mature over the next couple of years has to be refinanced, and not zero. It could be 1.5%, 2%, 2.5%. And that's when the problem really lies.
So why would someone want to buy Treasury right now if there's no interest attached to it? I mean, I've heard overseas in Europe, there's negative interest happening in a variety of markets, and it kind of, I'm not a financial person, so I'm, it kind of befuddles my mind as to, I understand why it's being created, but why would you want to buy something and not have any interest attached to it?
That's a great question. You wouldn't.
Okay.
So the biggest purchasers of these debts are the central banks that created it. They're monetizing their own debt. You don't buy them. So yeah, you're right. There's $16 trillion of global negative yielding debt. I have no idea who would buy something that you would lose money on at the end as a debt instrument. You just wouldn't do it. So what people here in this country are doing for investors is very dangerous. It's creating a false sense of risk. And what I mean by that is, so the typical retired investor who wants to get 2% or 1.5% on a CD doesn't get that anymore. They get nothing. So they call people like myself and they say, hey, Chris, what do you have that yields 2 or 3 or plus percent? And I'm going to say something like, oh, look at the preferred index or the credit index or a bond index of some nature, but it's going to fluctuate. And so when you have a time period like this, where you have people that are older that are looking for risk off assets start to go out into the risk spectrum to get income, they're going to get burned at one point. And that's very dangerous.
Interesting. I mean, I'll talk just from a personal perspective. Again, everyone, I'm not a financial advisor, so I'm only going to be giving my opinion on my personal experiences. And I know you can't comment on this because of your regulation and licenses, but I started to explore cryptocurrency back in June. And I did that because I felt like I had missed the Bitcoin, experience 10 years ago, and I saw how all that was going. And so I was curious about it. And I also knew that I wasn't getting a lot of interest in my bank account savings. So I put a small amount into Bitcoin in June, and it was at 0.41 euro, and now it's at 0.83 euro. So through the various trading that went on with that happens within the company, because I'm not the trader with it, I've earned a few $100s off a small package. And so it's like, I can see how people would explore other options if the traditional bank markets are negative interest or zero interest, because they're looking for different returns down the road. So how, what, let's, what are your takeaways, with what's going on in the markets? Again, we're talking on a podcast, we're talking on YouTube, so you really can't give, specific advice. But is there any generic advice that you can maybe give to the listeners as to what they should be thinking about and how they should proceed?
That's a great question. It's a very important one. People should be investing in their own risk tolerances. Know what the risk is. If anybody wants to know what the ultimate risk is in the equity or the bond market, look no further than March of last year or the third quarter of 2018 are great metrics for risk. It was some of the single biggest risk off moments in American history. If you can tolerate that kind of drop, then yes, that investment is suitable for you. But if you look at your portfolio and say, no, I can't take a 34% drop like what happened back in March, then, I wouldn't go down that road with them. And so we have a new benchmark that hasn't been created since 2008. So it's a wonderful but horrific event that you can refer to.
So you talk about a new benchmark. How do you do that though? I mean, what do you? I've heard March and 2008. So
sure.
What do you? I mean, I guess what should be someone's next step, especially if you're just getting into this area? Obviously, everyone should think about calling Christopher, and that way he can talk to you and everything. But you talk about looking at what your comfortable area of risk is. Are there certain products that might be something that they should be looking at? Again, without having, because of your licenses and stuff, I know that you might not want to say go this product versus another, but are certain areas quote unquote safer than others?
That's a good question. So yes, there are products that are safer than others. The industry is really good about talking about risk when it comes to ratings on a lot of websites that I've seen. Without mentioning anything specific, what people need to be cognizant of is what kind of return can they get for zero risk, right? So if you can go to the bank and you can get a money market at 2%, that's not bad. But if you're getting zero and people start branching out, how much money do you want to have at risk is a tough question to answer given the policy of the Federal Reserve, because it's creating, and look, this is just my opinion, it's creating a false sense of risk tolerances for people. And it is very difficult for me to answer. And basically what I was getting at before was there hasn't been a time period since 2008 where you were able to benchmark an ultimate event, so to speak, right? So when we had in 1 month, back in March of last year, we had the single greatest sell-off in the equity market in American history in 30 days. So if you look at an investment, if you look at a fund or an index product or some sort of security, and you say, wow, what did it do last March? And you can't tolerate that, I would advise you not to invest in it.
I guess the other thought that came to my mind while you were talking is some investments might be locked in. So you don't also have the fluidity of being able to pull them out right away. And that also means that individuals might not be able to get the cash back. And so they have to write it out. So I guess depending upon the product, that's another thing to maybe look at is it more for a long-term investment and sit and hold, or is it more for short-term where, it can help you with any sort of cash flow problem? So there's a lot of factors to take into account.
Absolutely. Absolutely. Learn your limits, know what your goals are. If your goal is to, preserve your money pre-retirement and you're 2 to 3 years out, back off. I mean, there's one thing that's not going to be worse to an investor than realizing they have to retire 3 or 4 years later because there were excess risk with greed and hubris attached to it that, ended up blowing up. For someone who's young, who's not going to be retiring for 10, 20 years, this is America. Things come back. And that's one of the greatest things about this place. We're not Venezuela. We're not, some third world nation where it takes eons to get something back here. This is a nation full of opportunity and prosperity. And if you're patient, take the Warren Buffett approach, long term.
I think on that note, I will thank you for being here. I know we're going to have continuing conversations. Again, everyone, you'll be able to reach Christopher on his on the website that will be posted. Why don't you say the website one more time? So for those that didn't get a chance to write it down, they'll be able to write it down now.
Absolutely. It's RHFIN.com. RHFIN.com. And Jacqui, thank you very much for being on, the ability to be on. And I really appreciate it. And I look forward to speaking to you again in the future.
Not a problem. And for those that are following my podcast and YouTube, please like and subscribe. That way you'll get new notifications of the areas of topics that we'll be covering, both in the finance area, in the travel area, and the health and wellness area. Again, it's all about, for me this year, it's all about what is your New Year's resolution and how are you going to achieve it? And everyone has their own personal goals. I know for me personally, it's to be able to travel again in a way that is with family and friends, as well as to become more financially savvy, which is why I love having these conversations, and just to follow my passions and have more fun. So anyway, everyone, have a great day, and I will talk to everyone soon. Thank you.
Thank you.